For decades, Australia has stood as a beacon of prosperity in the Asia-Pacific region, a nation rich in natural resources, bolstered by a strong service sector, stable governance, and a great living standard. However, the past year has seen many macroeconomic factors lead to the downfall of the Australian economy, with their output declining significantly. And despite avoiding many recessions in previous years, Australia's private sector will struggle to bounce back from this economic downturn. One of the most recent issues for Western economic stability has been the Israel-Iran war, putting strain on crude oil prices around the world. It has caused supply chain disruptions, making the price of crude oil increase as supply runs low. This has correlated to higher petrol prices, which has added to the inflationary pressure felt in Australia. The uncertainty in the crude oil market alongside inflation fears have pushed investors to the physical gold asset class. This mentality shift could boost gold mining industries in Australia, as the country is the third largest producer of the scarce commodity. Additionally, the gold price increase will increase exports on the metal due to greater profitability through foreign trade. Analysts have forecasted Australia's earnings to grow to $56 billion in the 2025 to 2026 fiscal year. The profound volatility in global markets alongside Trump tariffs have led investors to exit the US markets as uncertainty builds around their future prosperity. These tariff rates are less impactful compared to other Western countries, which will cause business costs to rise nationally. Despite inflationary pressures, global trade uncertainty and slower demand are likely to reduce inflation. This outlook aligns with the RBA's recent rate cut, pulling the cash rate to 3.85%, as Australia's current inflation rate sits at only 2.1%. Furthermore, the Aussie dollar dropped in value after Liberation Day taxes, causing imports to become more expensive. This has caused the mining sector within the ASX to underperform, relying upon cyclical commodity prices, which have been impacted by trade disruptions. These trade disruptions aren't exclusive to the US, but also China, as they are Australia's largest export market. The Chinese property market slowdown has resulted in weaker industrial output. This factor is the driving force behind decreased demand for Australian raw materials. So, what does this mean for Australia's future economic activity? Looking towards the future, Australia will continue to grow, although at a much slower pace than previous boom years. Sectors such as housing and education will maintain their demand in the Australian market as population size grows, despite projections of annualized growth declining by 0.2 to 0.9%. However, household spending will be constrained by cost of living pressures, largely decreasing consumption by households, therefore hurting GDP. On top of which, Australia relies on exports for GDP stability. This will pose as a challenge for Australia if Chinese demand slows for natural resources. The vulnerability on Australia's economic activity will persist unless diversification in trading partners is explored. There are also current geopolitical risks harming the future prosperity of Australians. The conflicts in the Middle East, trade wars between the US and China, and currency volatility cannot be controlled by the Australian government. This could prove problematic, as Australia's global market performance is closely tied to the US and European markets. Ultimately, Australia's economic future will be dependent on their ability to adapt. Shifting to a more self-sustainable economy, alongside innovation and technology advancements, would improve market efficiency and productivity. It won't be easy to implement, but long-term benefits will greatly improve the lives of young Australians.